In this section, we're going to discuss the terms at the money, in the money, and out of the money as it refers to options. Call options and put options are just the opposite in this, so I want to make sure you understand it. So I'm going to use several illustrations so that it makes sense to you how this terminology is used. The first one we're going to discuss is call option terms at the money, in the money, and out of the money. And we use these terms just to describe the attribute of the option. Is there real value of the option? If I were to go ahead and cash my option in, could I get real value for it? And using these terms will let you know right off the bat if you're able to do that. So let's discuss call options. And let's just say, for example, that the stock price is currently at $30. If the stock price is at $30 and you buy a $30 call option or sell a $30 call option, that option is considered to be at the money. If it's 1 cent or above or below that price, it is not at the money anymore. Out of the money describes an option that has no real value except for time value. So let's say, for example, we bought the stock at 30 and we own a $40 call option. This call option is considered out of the money. There's really no value. I can't exercise or go ahead and cash in my option at 40 when the stock price is at 30. So basically, anytime price is out of the money is when there's no real value, only except for time value. So if the stock's at 30, all the options above 30 are considered out of the money. So when I say out of the money, that means it's above. So the option is currently above the current price of the stock. In the money, the option has real value, because if I were to buy an option at, let's say, $10 and the current price of the stock's at 30, there's $20 of real value there, because I could basically buy the stock buy the stock from the option holder at 10 and sell it on the open market at 30. Any price under $30, if I own a $30 call option, it's considered in the money. So if the stock's at 30 and I own an option under $30, that option is in the money. So at the money is when the stock price is at the same price as the strike price. For example, if I own a stock and the stock's at $15, then the at the money price is $15. And here's an illustration to show you how that works. I like to use real charts to show my examples. So if the price of the stock's at 15 and the option I purchased is at 15, then I can say that that $15 call option is at the money. And it's just a way to describe how that option works. In the money is when the stock price is above the call strike price. For example, if the stock price is at 20, then the in the money option at 15 is in the money by $5. So, for example, if I own the $15 call option and the price of the stock goes up, it's in the money. So here's a chart. Let's say I own the $15 call option and the stock price is currently at 20. Well, that option at 15 is currently in the money by $5. Out of the money for a call option is when the stock price is below the strike price. For example, if the stock price is at 10, the out of the money call option at 15 is out of the money by $5. So for example, if the current price of the stock's at $10 and I own the $15 call option, it's out of the money, and it's out of the money by $5. So in this illustration, if the stock price is currently at $10 and I own the $15 call option, Well, that option is out of the money, and it's out of the money by $5. And out of the money says that that option has no real value as far as where the price of the stock is. There's only time value, which means there's an opportunity in the future to possibly make money on that trade. Okay, let's discuss put options. And put options are pretty similar, except two are just switched around. We have at the money, in the money, and out of the money when it comes to put options. So for a put option, if the stock price and the put price are the same, it's considered at the money. So if I bought a $30 put and the stock is exactly at $30, then that put option is considered to be at the money. A put option is considered to be out of the money if I own the stock at $30 and I bought a put at, let's say, $10. This $10 put is considered out of the money. Anything below, if the stock price is at 30, anything below 30 is considered out of the money. And out of the money options represent only potential as far as the value of the option, no real value of their option. And I'll get into that in a couple sections called time value, so you understand what I mean by that. But just know for now, any option under $30 is considered out of the money. In the money means there's real value. If the stock is at 30 and I own a $50 put option, there is $20 of real value, and it's considered in the money. There's a value to that option. Any price above, if the current price of the stock's at 30, anything above 30, those put options are considered in the money. So to review, an at the money put option is when the stock price is at the same price as the put strike price. So for example, if the stock price is at 15, the at the money put option is at 15. So here's an example. Here's a chart. The stock price is currently at 15. If I own the $15 put, that put is considered at the money. In the money is if the stock price is below the strike price. For example, if the stock price is at $10, the in the money put option at 15 is in the money by $5. So here's an example. Let's just say that the current price of this option is at the stock is at $10, and we own the $15 put option. Well, as the price of this stock goes down, the price of the put will go up because it's in the money, and anything above $10 is considered in the money for this put option. So for example, if the stock came down here to $10 and we own the $15 put, that put is in the money because it's above $10 and it's in the money by $5. Out of the money, if the put option, if the stock price is above the strike price, for example, if the stock price is at 20, the out of the money put option at 15 is out of the money by $5. So if the stock price is at $15 right here, if the stock price is right here, or I'm sorry, if the strike price here is at 15 and the stock is currently up here at 20, this put option is out of the money. So if the stock price is up here at 20 and we own the $15 put down here, this put is considered out of the money and there is no intrinsic value or actual value of that option. If we go to the Thinkorswim website or screen here, they do it for us. And let me try to find a stock that's pretty close to at the money. Okay, 197 is the current price of IBM. Notice how things are shaded here and they're white here. On the call side, anything that is shaded is considered to be in the money. Anything in white is considered out of the money. And on the put side, if it's shaded, it's in the money on the put side here, and it's out of the money here. And that's how you can just quickly glance at the option chain, and you can see, okay, is that option in the money or out of the money? And that will help you very, very quickly to ascertain where that stock price is.